webinar today. Today we're going to be discussing manager due diligence and how it integrates to our investment process at Amity Investment Solutions. If I haven't met you before, my name is Jessica Fannin. I am an investment analyst and strategist at Amity Investment Solutions, and I've been part of this firm for more than 10 years. During my tenure here, it has formed part of my role as a member of our investment committee, and so I'm deeply passionate about the benefits that due diligence can contribute to how you construct portfolios. The purpose of this presentation is that we'll explore what fund manager due diligence is, its key components, what qualitative information becomes really important when you look at it from different angles, and the tangible benefits that conducting a proper due diligence can contribute to the portfolio of the client. I think just to start off and define the topic, we've also got to talk about what the due diligence that we do is not. And we've got to understand that the due diligence on a stock or a private equity holding is very different to the due diligence that you would perform on a fund or a fund manager within the CISCA regulations, and generally the universe that we perform due diligence on is within the highly regulated realm, and we focus on manager due diligence within collective investment schemes and hedge funds that are regulated by the FSCA. Okay, so within that, to further define what is due diligence. Due diligence is the comprehensive appraisal of a fund manager's capabilities, strategies, and overall integrity. It involves a deep dive into both quantitative and qualitative aspects to ensure that the chosen fund aligns with the investment objectives and risk tolerance of the portfolio. Why is it so important? The success of any portfolio is closely tied to the performance and the reliability of the underlying funds. Effective due diligence helps to mitigate risks, it enhances returns, and ensures that we as investors are aligned with the long-term goals of the underlying managers. There really are two pillars to due diligence as it was defined, and the one being quantitative and the other being qualitative, the soft and the hard data. And the important thing with both of those is that they should confirm one another. You should be able to find quantitative data that confirms what a manager is saying, and that should enable you to take a view on a fund as a selector of said investment strategy. Quantitative analysis includes assessing the historical performance, risk-adjusted returns, expense ratios, and anything else that's measurable about the fund over time, be it allocation to growth assets, tracking error versus a benchmark, and various risk statistics. Qualitative analysis, the soft data, focuses on the non-numerical factors that can significantly influence a fund's future performance. Qualitative analysis and quantitative analysis should be analyzed together before you take a view on a manager. Qualitative analysis generally describes the style of the investment. You're considering the investment process. It should hold information around the team and the skill set that you are allocating to. It should also give description to the track record to both understand how relevant the track record is to the current team and the current investment process, so that you can look at the quantitative analysis and apply it with more insight. Just a small example, if a manager states that they are benchmark agnostic, there should be elements to support that. There should be large weights away from benchmark or active rotation of the portfolio over time to match what the manager is saying and be able to ultimately indicate whether their alpha is generated from those decisions away from the benchmark. And that's how we would match both qualitative and quantitative data. The role of qualitative information in the due diligence is to help us, number one, to understand the investment philosophy. The investment philosophy is really the bedrock of their decision-making process. and understanding whether they lean towards any one investment style or a blend of strategies is very important to us to better understand how we would then blend managers. The second attribute is team structure and stability. The team behind the fund is as important as the lead manager and should indicate how relevant the track record is. High turnover or over-reliance on a single star manager can raise red flags. And so we need to understand that if a portfolio manager leaves and a lot of the integrity of the stock selection sits with that individual, that it might change our view on a fund. Then another role of qualitative information is to give us insight to the fund manager's experience and track record, beyond not just within their investment track record. It might pertain to periods prior to that, where they might have sat as part of a credit team or on a sell-side company, but really to establish how much belief we put in the inherent skill set of a fund manager. And then, of course, because we want to align the interests with the client, this includes assessing whether a fund manager has skin in the game, whether they get their bonuses and have to invest them for a certain period in the fund, and how their compensation is structured. We want to understand whether a portfolio manager is assessing themselves against relative performance, against an index, or if they're far more absolute return minded. Not to say that either one of those excludes them from what we would consider to allocate to, but it better then helps us understand which portfolios they might suit better. If we look at some bond managers, we currently have a bond manager who's very absolute return focused and another who's quite benchmark relative focused, and we can blend those two at different weights depending on the risk, the budget of risk across our portfolios. What are some of the benefits of qualitative due diligence? Focusing on those soft data points. It helps us mitigate risk. It gives us long-term alignment with the fund, and it assists us in blending those managers and possibly identifying managers who could add outperformance. So when we look at mitigating risk, we can identify red flags up front. So whether that is very concentrated bets in a certain sector, whether it's a global manager who loves technology through the cycle, we need to manage that. And that only comes through understanding their investment process and their investment universe from a due diligence meeting. The long-term alignment ensures that actually we're aligned for sustained success. And we want to believe in a fund manager enough to ride out periods of underperformance. And then, of course, we want to build trust and confidence in the skill set that we're exposing our underlying clients to. We can obviously reduce overlap between funds, and that helps us with portfolio construction. And in terms of identifying outperformance, we really want to identify funds that have an edge in terms of their ability, their investment universe, the skill set and toolkit available within that mandate. And ideally, you would like a mix of managers that have multiple drivers of alpha that they can contribute to the overall solution of the client. Just a very quick case study on applying qualitative due diligence. Let's consider a case where we have two funds with similar historical performance. However, upon meeting with both managers, we find that one fund has a very stable and experienced team, while the other has seen high turnover and clearly has seen a big change in investment process and philosophy as a result. The outcome is that we would favor the former. We would favor the fund with the established track record where the team is likely very stable, and we can gain confidence that that would be a better long-term choice for our clients. What about passive funds and ETFs? We often get the comment that, well, due diligence isn't as important because a passive strategy has been employed in a client's fund. And we would beg to differ with that argument. We think that due diligence is equally important when you're considering passive funds or exchange-traded funds. And what are the things that are important when assessing these mandates, because now you don't have an active manager with an investment process, well, then your due diligence focus switches to looking at the fund management and the sponsor quality. You want a big fund house that is able to allocate large amounts of money to replicate indexes in its entirety. So bigger is better. You want to really understand the index that the fund, the passive structure is selecting, and how the method that it is replicating that index. So you need to ask yourself, can you track that index, or is it a proprietary index? And what method do they use to replicate that for the client? We need to consider liquidity and market performance. There are a lot of niche ETFs out there, and we need to understand, well, if they are investing in a certain sector of weight loss drugs within a health sector, how much liquidity is there for that? We then want to look at other statistics like tracking error and costs. A lot of ETFs have hidden costs that are not necessarily evident in the EAC. And so you need to consider how often the client might be trading on that position, whether they're up or down weight, because that may trigger trading costs on the JSE. And of course, we need to look at the ETF structure. How is it replicating the index? Is there contracts for difference, or are they actually buying the underlying stocks? Because both of those things have risks when it comes to liquidity, or how easy it is to deploy inflows or outflows. Then another major topic within due diligence that is becoming more and more relevant at current is the need for due diligence with hedge funds. As retail hedge funds have become widely available to clients on list platforms through advisors, it's become more important that hedge fund due diligence forms part of our traditional due diligence databases. What are the key things that we need to consider around hedge fund due diligence? And here, it really is my opinion that partnering with a DFM can have significant benefits. Why is that? Well, data is a lot harder to come across with hedge funds. It's not necessarily freely available on certain platforms. You can't just compare hedge fund return data, and often you've got to pay for it. So even just the quantitative side of things is significantly harder, and that's actually crucial in first as your initial due diligence work. It does help to understand the long-only offerings of a hedge fund manager. It does give you insight to the skill set within those managers. Often the returns on hedge funds can seem too good to be true, and you really want to assess, is that return just by virtue of gearing, or is there actual stock selection and portfolio management skill sets which are apparent in the long-only funds, which are often far more readily available to assess? The advantage of hedge funds only being made available to retail investors quite recently is that there generally is a wealth of data available on the qualified investor hedge fund side of things. So the hedge funds that are not necessarily available on lists, but they generally have a much longer track record, and that enables us to go and scrutinize what these managers are doing. And lastly, I think the very critical thing is to understand how leverage is used and what toolkit is available to a particular hedge fund manager. When we consider hedge funds from a due diligence perspective, it's not as simple as the long-only space, because the underlying asset class is not necessarily an inherent indication of how much risk the client is taking. I'll take an example of 4 hedge funds. 2 of them are fixed income hedge funds, and 2 of them are equity long-short. And inherently, from our knowledge of the long-only side, you would associate the equity long-short managers with a higher degree of risk than the fixed income managers. But that's not actually the case. When you consider the annualized return, one of the fixed income managers generates a higher return than one of the equity long-shorts. When you look at volatility, much the same. One of the fixed income managers produces a higher level of volatility, a higher level of maximum drawdown as well, and a lower minimum 1-year return, which tells you that the set of outcomes in terms of returns is wider, if not wider, than some of the equity managers in the space. And so you really have to meet with these managers to understand how much risk they are taking, how much leverage they're employing, what is the gross exposure that the client is exposed to through time versus the net exposure within these funds, and what hedged instruments are they using to gain portfolio exposure. Another big aspect of due diligence is that there are two separate methodologies of due diligence when looking at a single asset class fund versus a multi-asset fund. And this is quite key to a lot of the work we do within portfolio construction and ascertaining what fund managers are relevant in certain spaces. So I just want to spend some time looking at the differences between how you would perform an interview on a single asset class fund versus a multi-asset fund, similar to your normal balance fund. So when looking at a single asset class fund, your depth of analysis really focuses on the manager's selection ability within a sector and their expertise in valuation methodology within one asset class. Those skill sets tend to be very deep and quite narrow. When you're looking at a multi-asset fund manager, what really stands out is where there's skill set for portfolio construction and blending different asset classes. Within that, they might have good stock selection ability, but it's not as relevant necessarily. They might outsource that to some of their analysts or employ other funds within the same fund house. How the two different funds react in different market environments is also important. We would hope that multi-asset managers are better able to allocate between different asset classes during different market conditions, whereas a single asset class fund, you would expect them to ebb and flow with how that asset class moves within the market conditions. But what you want to ascertain is their ability to move between sectors and change views depending on what's in favor in that particular market condition. Another key aspect for us to understand from a due diligence perspective is how they diversify. Diversification of a single asset class manager is measured against a benchmark, whereas a multi-asset manager, diversification happens across multiple asset classes, and diversification is measured often using your risk-adjusted return metrics and correlation attributes with other multi-asset managers. When we look at risks within these two different buckets, single asset class funds have very specific risks, and you often have to focus on the level of concentration that a fund is introducing, whether it's sector concentration or single stock sizing. With a multi-asset fund, you've got to look at cross-asset management, risk management. And often their risk management is very dynamic. It changes through time. It's not necessarily as stable as a single asset class fund. As we analyze performance for a single asset class fund, we obviously focus on what is the benchmark and what other funds have a similar investment universe to that particular manager. We focus a lot on analyzing the alpha generation, and we strip out the alpha and measure correlation between managers within the same investment universe category. With multi-asset funds, you've obviously got to do a lot more work around creating complex composite benchmarks against which to measure them. And then your focus from a performance perspective often lies with a focus on risk-adjusted metrics. From an operational side of things, we would expect that single asset class managers should have specialized research functions and capabilities that focus on deep work within one asset class. Multi-asset funds should have a broad range of expertise sitting within the team, and it really is about understanding how those different team members collaborate on their different skill sets. So there might be a fixed income focused analyst and a resources and industrials focused analyst, and how does that information reach the portfolio manager and get blended? Within the operational considerations it's ideal that a single asset class fund has simplicity around that, and that the underlying researchers have the ability to focus on their particular stock set, while in a multi-asset fund, you want to make sure that there's operational infrastructure to support the fact that they have so many different moving parts to assess continuously. And so often, outsourced software or risk analysis becomes a little bit more crucial for your multi-asset managers. From a fees and cost perspective, what we really want to ascertain across both these fund categories is that there's alignment from a cost perspective with clients, that performance fees or how managers are compensated really aligns the client to the investment. One of the things that we have to consider is when deeper due diligence is required. When do you have to go the extra mile and do far more interrogating from a due diligence perspective? And we think there's a couple areas. One being when ESG is a big factor. This is because a lot of products have been sold or marketed as ESG products, but when you look at the underlying holdings, they don't necessarily meet all the requirements or the client's understanding of what meets ESG. And so you do have to do a lot more scrutinization of underlying holdings and single out the risk factors within that. The other aspect is when there are religious considerations to the client, because that can adjust the investment universe, and you've got to go and consider which investments truly represent that well. More due diligence is required. And then, of course, the obvious. When you step outside the regulated listed space and you consider opportunities like private equity or other unlisted instruments or property portfolios or securities, and then various structures where the outcome of the investment is not necessarily straightforward, just a return outcome from the underlying investment. Deeper due diligence is required by whoever is selecting that for the client. To use an example, when a private equity opportunity is presented, by a client or a possible investor, advertising double-digit returns on the side of the highway, as some of them do, what are some of the due diligence questions that have to be answered? One would be, what is required for the client to realize that return? How is the liquidity going to come about after the investment horizon for the client to walk away with their money? Is the portfolio manager, is there evidence of a track record where deals have been closed or that underlying private equity has been paid out to the actual investors? And how did that happen? Does it usually happen by a manager buyout, or does the security actually have to list on the stock exchange for underlying investors to get their money out? Or are they only relying on a constant stream of dividends to really pay out investment returns? Some of those things need to be considered. And I would actually say that within that unregulated environment, it's actually more important to go and kick the tires physically and actually do things like site visits and sort of understand, is the value of the underlying investment as high as what is being represented in the marketing to investors. When you compare that to a local equity fund, which doesn't necessarily promise any guaranteed return, but has a history of producing alpha in a low economic and growth environment, then you definitely feel safer understanding what's more appropriate for certain clients. And certainly where investors have a much longer investment horizon and are well funded, one could start to consider going outside the more traditional landscape. But certainly there is a more onerous requirement for due diligence in that space. One of the key considerations is to understand what is not considered a due diligence, because sometimes we can gather information from different sources, but they don't necessarily amount to a significant enough amount of information to say that a due diligence has been completed on a certain fund. And we would say that some of these activities can be supporting of your insight to a certain manager or fund, but they don't necessarily constitute a due diligence. And some of those activities would include attending a roadshow or reviewing fact sheets or marketing material from a said fund manager, or even meeting with the broker consultant which represents a certain fund house. Another aspect which doesn't constitute a due diligence is meeting with one fund manager and associating that skill set with another portfolio within the same fund house. There still needs to be confirmation of investment process and investment universe, and so actually more information may be required. These can all be supportive of your view of a manager, but they often are not sufficient to replace meeting with the manager, albeit online, and having certain questions answered. Where we have to be careful is it's not always possible to meet with every fund manager that we are considering for investment. And specifically, a case and point would be considering offshore equity managers. The portfolio managers are not always available to us as South African investors, and there far more quantitative information has to be gathered to support what is being stated in their prospectus or in their material, to give you a robust understanding and confirm some of the inherent views on that particular manager. I think it's also important to note that behavioral biases can creep in when you are performing a due diligence exercise, and we need to be cognizant of that as people who are selecting funds on behalf of investors. We need to ensure that we are not favoring certain fund managers because there's another fund that we like, or associating a high level of skill to the overall investment team because of a charismatic fund manager. There has to be robust support for all of those things, and it's very important that when we stand back, that there's significant record of due diligence to support the fact that we've done enough work on a fund. The last topic we would like to address is, how do you do a due diligence on a DFM? How would you perform a due diligence on a company like Amity when that information isn't necessarily always available in a comparative format? And certainly advisors in particular are sometimes at a disadvantage from the quantitative side of things. Well, we would say that actually you need to look for an evidence of process. It needs to be clear how a DFM employs due diligence processes and quantitative analysis to consider different investment solutions for clients, and there needs to be good evidence for how they do portfolio construction. Ideally, there should be high stability of the investment team. In a DFM, we're not of the opinion that there necessarily has to be a very large investment team, because there are great tools to slim down investment opportunity sets and do focused work for clients. But the stability of the investment team is quite critical. Investment teams should also be focused on doing research. On the day-to-day, they should not be doing marketing all the time. They should be allowed time to really focus on understanding the dynamics of underlying markets and how to reviewing their portfolios ongoingly. And it does present a red flag when you start seeing portfolio managers on the road the whole time, and you realize they're actually fulfilling a marketing role more than a portfolio management role within a DFM. We think it's also important that you find DFMs that are client-centric in their investment solutions and don't just mimic what's currently available in the market. Do they speak to the goals of financial advisors and clients to improve the degree of certainty around the financial planning objectives? Are there considerations around products and tax implications and a suite of solutions that can be applied in different financial planning situations? There are a growing number of resources to review or gain information on DFMs, such as Citywire, publishing information annually on their views and underlying positions, and they are in the process of launching a tool to look at comparisons quantitatively between different DFMs. And of course, then there are other parties like Fund Hub and Collaborative Exchange, who do annual surveys on this set of investors in our market, and that can be used to gain a view on how these different portfolio managers employ skill sets and whether their investment teams are local or they're feeding into an international view and just applying that across local lists. But that said, we would like to present the opportunity for you to get in touch with us should you feel like you would like to perform a due diligence on us as a DFM and review some of our processes of how we consider underlying fund managers to better enhance your process and your interactions with clients. Thank you so much for attending today's webinar. We really appreciate your time. As always, our webinar will be uploaded to YouTube, where you can also find a wealth of other webinar content on our channel. We encourage you to please like and favorite the channel for future resources to be made available to you in a convenient format. Thank you again for joining us.